All right, so I'm going to go ahead and kick it off right now. I'd just like to say thank you, everybody, for showing on up this cold Wednesday evening. So we're going to spend about 25 minutes or so talking about the year in review and also the fourth quarter, uh, what we expect in the year ahead, some things to consider. And this is going to focus on more of the outcomes instead of
Mhm.
strategy like we have done
Oh, so
in
it's
previous well, Zoom calls. So, and also if everybody could please make sure that you're muting your own microphone until we take questions at the end. Uh, so yeah, and we will be taking questions at the end, about 50-50 between the presentation and the questions. Okay? So without any further ado, I'll go ahead and kick this off. I'm here in Virginia Beach, Virginia, and I'm with my daughter who also works with me, Megan Cahoon, and we'll press on going right now. And this is being recorded also. So just as a kind of a review, one item on strategy, what we have here is that we use the when and the where concept in order to know when we should be in the markets. And we use moving averages for that and candlestick reversals in previous TSP tips Zoom calls. We go over those in pretty much detail. And then also where to be is the next portion of it. And we use performance rankings and also composite scores, which is 10 different criteria that we use within the TSP in order to determine what fund to be into. Okay, so how did we do in the fourth quarter? What you'll see here along the zero axis, of course, you have the TSP individual funds, the GFC, S and I, and then you have the TSP tips funds, which are the aggressive, moderate, and conservative models, followed by the mutual fund window, which we just started uh, utilizing with the subscribers in the fourth quarter of this year. So, and you can see by color code, blue is the first color quarter, dark red second, gray is third, and the fourth. So as we look at this, you can see some things that stick up. I mean, they come to light right away. Uh, the funds from the C over, everybody, all the funds had up quarters in the first quarter. Started out the year fine. Uh, and if you look at the different funds, there were three different funds that had all quarters being positive. And that was the C fund from the TSP, the aggressive fund from TSP tips, and also mutual fund with a window. They were all up. The largest loss that we had, and this is kind of amazing if you really think about it, is how poorly the I fund performed in the fourth quarter. The loss there in those 3 months was just about 7.5%. And the largest gain we had, this was using back tested, was the about 12% for the mutual fund window on the far right in the blue stick there. So, but the difference in returns, and we have this presentation in a PDF format, and we'll send out a copy of it to those individuals that have signed up this evening. Okay, moving on to the year then. Here's what we have. This is on pretty much an interesting thing. While the other one, first screen was on the last quarter, excuse me, on a quarterly basis, this is on a yearly basis. And if you look to the left, right in the middle, you have the mutual fund window, the new service that we started, and everything to the left are the same funds that you saw on the previous slide. However, on the right side, those are all the life cycle funds that the TSP has to offer. And you can see how they phased in. So if you look at it, let's say I'm going to focus on the C fund, the C fund. It had nice return this year of about 25%. S fund was about 16, 17%, and the aggressive model was around 15%. And if you look at that green line that goes along the 15% line, you can see that the aggressive model outperformed pretty much the majority of the shorter term, let's say, through the next 25 years, through to 2050 of the life cycle funds. However, it was just below the 2050, 55, 60, and 65 life cycle funds. Now, I'd like to go ahead and just talk a little bit about the life cycle funds, since you can see how the performance, of course, increases the longer the duration of the life cycle fund. So let's just focus on the 2025, 60, and 65 funds. All three of those funds have just started within the last few years or so. The 2055 fund started in 2020, but you can see what their current allocation, they're all the same for those three right blue sticks there. And you can see the majority, well, 1% is in the G and the F fund, and the other 99% is in the equity funds, split as you can see there, 51, 13, and 34. Now, I want to direct your attention up to the sand chart up in the top left corner. That is the allocation of the 2055 life cycle fund from inception, which was July of 2020, all the way through July of 2055. And that black beautiful vertical bar shows how it is currently allocated. And it's those same pie chart over there that we were just talking about on the far right in January of 25. Now, what will happen over the years, the equity portion, the green, blue, and the purple sections at the bottom, they will gradually decrease as time passes. But the allocation is set for the next 25 years or so, or 25 years or so. So that's how it looks. If you go to the life cycle funds that mature in 2030, that vertical black bar will be further over to the right. But that's how you're set up over time. And the life cycle funds use diversification and an age-based strategy in order to determine how much should be in the equity split of the portfolio. Conversely, if you look at just to the middle of that chart at the bottom, the TSP aggressive fund currently has 60% in the C fund, the brownish section, and 40% in cash. Just so that you know, the moderate fund has about 50% in cash, while the conservative fund or the model has about 40 in cash. But the difference is between the life cycle model using age and specific allocations, we are more tactical, let's say, where we move money around based upon what the market conditions are versus time. Okay, so that's it for the year. If you look there, what's pretty amazing too on this slide, I'll just point out on the very far left, you have the G fund that returned about 4%, but the F fund was down there at about 1 fund, and the I fund was also about equal to what the G fund was. So moving on, this is a chart that shows the growth of $10,000 in the TSP tips models. You can see there, the blue is the aggressive, and the moderate just kind of eked out the conservative. And then you have the mutual fund window in the green up there. Again, the mutual fund window was only established for client or for subscribers in the fourth quarter. That's when we opened it up for a subscription there. Okay, moving on.
The game right, get in there.
Okay, if everybody could please mute their mics, it would be appreciated. The mutual fund window. Again, I've mentioned it a few times tonight already, but this is what it looks like for you, those of you that might have an interest in it, and this is how it's used. What I did is I opened up this account based upon the criteria that the TSP mutual fund window people have. So I put $35,000 into it on the 15th of August. That's when I started this account. And this is a screenshot from the other night. And you can see it's grown from 35,000 up to 40,183, which is down there at the bottom left. Let me get the pointer on here, laser, down in this area over here. Okay. So how did we get there? What we do is that the mutual fund window, how we currently have it set up, well, in the fourth quarter, was we utilized the UOPIX fund, which is listed over here. The ProFunds Ultra NASDAQ 100 fund, the symbol UOPIX. And what it is, it's an index fund based upon the NASDAQ 100. But instead of having a 1-1 ratio like the TSP funds, the C fund, let's say, this is a 2-to-1 ratio. So if the NASDAQ 100 goes up 1%, this fund, the Ultra NASDAQ 100, will go up too. Conversely, if it goes down 1%, this will go down. So you can see down here is that this was the initial purchase of 35,000. We got some dividends reinvested in it while it was sitting in the money market. And then we did a redemption from there, a fund transfer, basically, from the money market, 100% into the Ultra NASDAQ 100. Here was we had some other dividends that were declared. We reinvested the dividends, and then we ran the value up to $40,153 from the original 35, let's say. And then you can see on this area right here, this is where they subtracted the fee. And then at the end of September, we got some dividends on the cash that was in there. But this is how it looks, the screens, so you can see how it operates. And how we have it set up, and we recommend this, is that if you do want to invest in this, we recommend go 100% in and then 100% out in order to cut down on the transaction costs, because each transaction is going to be about $30. Okay, so that's what it looks like. Now, what does it look like a little bit behind that? On that specific trade, this is the chart that showed that Ultra NASDAQ 100 over here on the far left. Okay. Purchased it for the subscribers was on 20th of September, $104.17. It moved up through October. November came around. We had the election bump that came around, which drove it up until the middle of December. And then we had that market sell-off when Fed Chair Powell came up and talked about the projected interest rate hikes and the number of those, projected interest rate reduction, and reduced the number of them that would be proposed in 2025. We saw the market sell off. We sold it at 115.92, and it's basically with a gain of 11.25% over that time frame, the 20th of September. So 3 months, basically, October, November, December. Okay. What we have done currently is that we've expanded this in order to try to take advantage of some of these other unique funds that the mutual fund window has. And the next one that we have offered, we haven't done a trade on this with subscribers, but we have back tested these things. And this is the most current fund that we're going to have. Again, it's a ProFunds, but it actually invests in Bitcoin. So again, we're trying to find those unique areas that are outside the three funds that the ProFunds, that the TSP has to offer. And you can follow these signs. You have the index symbols over here, the mutual fund symbols over here. This is Bitcoin, BTC, FX, okay? Now what we did, using the same criteria, this was the buy that would have been on the 1st of November. Remember when I said it had the election bump? Came around 23.29, and we sold it just before Christmas, on Christmas Eve, at 33.12. and that gain was about 41.5%. Okay, so that's how we incorporate this. And what we try to do is we've looked at these things, and because there's a cost to do the transactions, the number of transactions that would occur on each of these funds is about 3 per year. We stay in about 3 months, out of the market about a month or two, and then back in as the markets make their next leg up. But those are the two funds that we're currently offering through the mutual fund window. And we have instructions on how to set that up. And the TSP site has a lot of information on what is the criteria in order to start to invest in there. So that's the UOPIX, the BTCFX, and this is what it looks like on the updates that you would get. Now, everybody's familiar with whether they receive the email or use the app for the TSP tips. We don't get into as much detail as following the week, but what it does do, it mentions the current status that we have, last trade, and what the current price was. This is from about a week and a half ago, 2 weeks ago. And the important part here is that when we're in cash, which we are right now, we enter in what's called a buy stop. And a buy stop is nothing more when it hits a certain level. You'll have this from the week before, but we'll also send out an alert the day that it does increase its price at that or above that, and say, okay, move 100% cash from the money market in the mutual fund window and purchase the UOPIX, which you saw in that transaction a couple slides back. Same thing for the Bitcoin strategy. There it is over here at the bottom. Last activity that we had and some of the previous results that we had back tested down here. This was from a week ago, 2 weeks ago when we started this. We've taken this off currently. But again, you also have a buy stop over here at 31.25. Excuse me, at 35.79, and the current price is 31. So that's what it would look like when you were looking to purchase it. Okay, if it hits these levels, I'm going to go ahead and move money into those respective funds. And conversely, once you have those funds, you're holding them, then we would say a sell stop, which say if it hits this price, we recommend that you sell that. Okay. So that's how it looks like from the mutual fund window. And then how you can incorporate this. The mutual fund window is structured more for those aggressive type investors. Okay. So if somebody's going to invest it, it's usually a person that's already in the aggressive model, not the moderate or conservative model. So just looking at the fourth quarter, the TSP aggregate gain in the fourth quarter was 2.19%. And the mutual fund window is 8.5%. So what I said is that, okay, the criteria says you can invest up to 25% in the mutual fund window. So basically I said a 75 remaining in the tips, the regular TSP, mutual fund window allocation is 25. You do the math, 1.6% of the aggressive mutual fund window, 2.15. And then your total return would have been in the fourth quarter, 3.79. Conversely, a 2.19. So it does bump it up somewhat. And that's a way that we can, these funds that we've selected there, again, they have more volatility. They're not a long-term investment where you would hold it for years and years and years. It's short-term because it uses a daily rebalancing. But again, we use the stop levels in order to define when we enter and when we would get out of the respective funds. So that was 25%, 15%. It would have equated to 3.15, and only having 5% in the MFW window, it's 2.51%. Okay, just something to take a look at. But one thing you can do is that a lot of times when I talk to people and things like that, I kind of make notice and say, you know, you have TSP tips for your TSP funds, and that's the kind of allocation that we have. But remember, the C fund, the CSMI fund, and also the F fund, they all have benchmarks. And the C fund's benchmark, let's say, is the S&P 500. I'll use that. Now, if you have your own personal IRA or somebody, your spouse has a 401k or you have an old 401k, things that you could consider would be to say, okay, does my current IRA have an S&P 500 index fund? And usually they will. And you can go ahead and use your TSP tips allocations, the investment mix, in order to determine your investments if you'd like to go ahead and apply those to your IRA or 401k. The other thing I'd like to mention is that if you do have a brokerage account or an IRA, let's say I have one at Schwab, the biggest difference, and I was kind of surprised when the mutual fund window came out of the fees involved with it. But it's nice. If you did want to purchase this in Schwab, this is their screen. Just call up the symbol over there, UOPIX. A minimum of investment is $100, no transaction fee, and no sales load. Okay, so big difference between the two. You're not worried about 2 times the trade each month. You can do it more often. But again, 2 ways to go ahead and incorporate the TSP tips that we have, maybe in another retirement account that you might have, and also how you might incorporate mutual fund window also. Okay, way ahead. So again, we're going to come back for questions, but let's take a look at 2025, and we're into it already. Some of the things that always occur at the beginning of every year, and you've heard about it in my news weekly updates. We talked about recently about the Santa Claus rally. Well, then we just finished up today, the first 5 days, and also the January barometer. And then we also have the presidential cycle. What happens in the first year of the president's term? So the Santa Claus rally, it did not pan out what we wanted. Okay. Usually it looks at the last 2 trading days last 5 trading days of 2024, and then the first 2 of 2025. What happened there is that it was down. And usually if it's up, the return for the whole year is 10.4%. But if it's down, the return is about 5%. Okay. And then the first 5 days, that's been actually, we just finished that up today. It's the first 5 trading days of January. So we had last Thursday, Friday, and then Monday, Tuesday, and Wednesday this week. We did have up, and the 48-year average of that has been 14.2%. So again, that looks positive. And then the last one of the trifecta, you have the January barometer, which says, as January goes, if January is an up month, so the year is also up, and that has an 83.4% accuracy. So about 8 out of every 10 years, the market performs as the January performance. And here are just some other indicators. If all 3 were up, the average gain in those years had been 17.7, and if all 3 were down, it was minus 3.6%. So just some things that we look at the beginning of the year. And then I mentioned about the presidential election cycle. And of the last, remember, we're just looking at 1 year out of every 4 post-election year. Out of the last 18, 10 of them are up and 8 of them are down. The total gain during those periods, those 18 single years, has been 127%, which means a 7% average gain in the post-election year. Usually, it's a nice gain, but we've also had some good gains over the past here. But just to kind of give you a ballpark figure, at least they're all looking positive, let's say, so far. Now, this is unusual since usually you don't have a president that has a gap in between his terms. Here was the last cycle, in case you wanted to look back and see what happened in the 4 years of the Trump previous Trump 1.0. So the post-election year, up 25%, then a small loss, and then up again 20%, and then 2020, that was kind of much lower. But again, COVID fit right in there in March of 2020, as usually everybody remembers. So, some other factors to consider. Economic growth. We didn't go into a full-blown recession with the interest rates. It appears as if the Fed guided us to a soft landing. We didn't hit the other end of the spectrum. The market continues to be bullish, although I have some concerns, which I'll cover a little bit. Unemployment rate is low, which is good. And inflation is down significantly from where it was about a year or two, about 2 years ago. And interest rates are down, but they have been reversing themselves, as you'll see right here. This is a 12-month chart of the 10-year Treasury note over here. And starting in January, over here, again, 1 year at the bottom, January 1st through December, or through present, the beginning of January here. And you'll notice that the interest rates were high back in here. They continued to go down on a 1 year term. And then right around the October timeframe, it started to move back up. And over the last 3 months or so, we've been in the nice, let's say, an increasing interest rate environment. Even though the Fed has been lowering rates, and they've lowered it 2 times recently, it hasn't really brought the interest rates down if you look at the actual notes that are tied to them. In fact, it looks like with the market's action today, interest rates went up again on the 10-year note, and we might just be above the 4.7 level, which we are right now, which would be the highest point in just over a year within the last 52 weeks. So the thing about it is that as interest rates rise, though, the price of the F fund moves in the opposite direction. We'll cover that in a minute. But let's just think about in the last 3 months on the direction of the interest rates here on the 10-year note. And let's look at it from a different perspective. A little bit more detail on those last 3 months of the 10-year here. Again, notice it's been going up, came down a little bit, and now it's back up to that 4.7 level that I was just talking about. And at times you can see how rising interest rates put pressure on the market, because if you can get a higher rate with notes, bonds, and things like that, people will go ahead and migrate through supply and demand into that area. So here on the left side is the same 3 months period that we're looking at. And you can see the initial shot up after the election. It fell down over here in mid-December, the last half of November, popped up again till mid-December. And then right about when Powell started talking about the number of rate reductions in 2025, we've seen some market volatility. So if you look at this over here on the left side for the beginning of December, you can see how it equates to on this side. Stocks seem to be going down here as interest rates increase. And the one thing that I've seen over here, and I mentioned a lot, is about 1% daily moves, daily moves of greater than 1%. In November, we had, and this has had increased in the last 3 months.
Number 25's got Arnie in a tizzy. 25.
Yeah. So, but November we had 2 moves up.
I mean, to the point where he's like kicking. I was like,
and can everybody please
thought he was fixing to take on.
Could everybody please ensure the mics are muted? Thank you.
He was looking like he
And
was about to, and then Honeybun came up, so he focused his aggression to her.
And then we've had two moves to the upside, one to the down.
I don't know how old they are.
If everybody could please,
Wendy, can you please mute your mic? We can all hear your conversation. Thank you.
Yes, thank you.
okay, so we've had two moves up greater than 1% in November, one down, 3 and 3 in December. That's a lot of that volatility that was in this area over here. And then in January, we've had one up and one down. And that's within the first 5 days of trading in January. So it's been pretty volatile over here ever since over the last 2 to 3 weeks. So we'll see where we go. All right. So these are some graphs that you usually don't see because the TSP does not, they publish their daily prices, but he can't go to Yahoo Finance and pull it up because it's not a mutual fund. Okay. It acts like a mutual fund, but it's being held within Blackstone or BlackRock, excuse me. But here's the individual prices. If you did look at the F fund, and this is for the last 2 years, okay? And the thing I want to point out here is that I mentioned at the beginning, moving averages, the 20 moving averages in the blue, and that looks at the last 20 days of price movement, averages it out, and then the same over here is the 50. And usually it's bullish when the 20 crosses above the 50. And you can see how that has migrated on the F fund. But remember when I said that interest rates, as they continue to go up, the F fund moves in the opposite direction. So we showed you that the 10-year notes right at about 4.7 now. And you can see the drop off over the last 3 months of the F fund. Okay. Now, I'll just show you real quickly. The other ones, G1, everybody's going to expect that. Boom. That's what that looks like. Never loses money. Return somewhere around 4%. Annual return, which is over in here. And then, of course, the averages just stay right behind them. Now, the next three are the three equity funds, the C, S, and I. So let's take a look at those and also look at that 20-day moving average, which is the light blue line. Here we go. Here's the C fund. You saw how it moved around in this period. This is November recently. And you can see the crosses, where it crosses above it and it continues on. And then when it crosses below it, it has the tendency at times to take a break, consolidate, or even go down, like in this area. So right now, we're looking at this. The 20 is moving down. It had to cross below, but the price is below the 50. So just something to be aware of. And notice how this thing peaks out here just over the last 2 weeks, and the 20 starts to reverse to have a slope to the downside. Now that's the C fund. Let's look at the S. You can see what's happening there. S fund has been very volatile, especially over here in the last few months in the fall over here. And you can see how it continues to go down with the 20 almost crossing the 50. And then finally, the international fund. And that's how that looks. You can see it's crossed back here in all three of the models. I'm pretty sure we don't have any in the international fund and in the aggressive and the moderate models. I think we may have maybe 5% in the conservative one. But again, that's how the funds go ahead and differ. And this is a 2-year period, and you can see how that varies there. All right, onward. And so basically, that's about it that I have tonight. I want to ensure that everybody, was able to take this, and I'd like to open up the floor to any for any questions that anyone might have. And I'll ask Megan. We don't have anything in chat. Okay. So as anybody would like to ask me something, I'm more than willing to sit here and answer your questions. And now's the time to unmute. Okay. No question. Okay.
Yeah.
Yes, please.
How are you going to handle the first year? There's a lot of predictions out there, a lot of experts saying best that we're going to do this year may be the upper, 9% to 12% a year, looking for March to be a down month, et cetera. How are we going to handle that for our investment and the timing that you
Okay.
send out?
Yeah. And again, I want to, what we have is that we've already made adjustments over the last couple, 3 weeks. I'll talk about like I mentioned earlier that the aggressive fund is 60%. We've gone back from 100% down to 60. In the moderate, we've gone from 100 to 50. And in the conservative, we've gone from 100 to 40. And if it continues on those trends, we always like to let the trend be our friend. There's no sense in keeping money invested into funds if they're going to keep going down. And at times, and this is where the difference is between the life cycle funds, which I talked about at the beginning, and the TSP. If the markets continue to go down, what we will probably do, it's this week, it's the 13th on Monday, and we're right about mid-month. If they continue to fall, we might just take a little bit more off of the table and decrease the allocations by maybe another 10% or so. Again, depending upon what happens on Friday. The markets are closed tomorrow for President Carter's National Mourning Day. But what we will do is that we will decrease our allocations in it. And if the C and the S and the I fund aren't going up, it's very hard to make any money. It will be difficult to make any money in the market. But I do want to say that, on this little slide right here on the right side, no one can predict the future. And making money takes time, patience, and persistence. So you can't, if the market just don't go up, you need to find, by using that performance ranking that we always look at, those areas that are strong, and usually the C, the S, and the I fund all work in tandem. But you can see on the charts there, the I and the S fund haven't been performing well. So I guess the answer is that if the markets is going down, if it continues down, let's say through March, you can look at it seasonally, what it's done in the past, and then you have to balance that off of, like, let's say the first year of Trump's first term, I think it was mid 20% that he had. You just have to be nimble and flexible. And if the markets are, by price action, start hitting new highs and reversing their trend, let's say, we'll have more invested back up to 100%. If it doesn't, then we'll go ahead and continue to take some money off the table. But you always see people predict what it's going to be for the next 2 years or the next upcoming year. But I always like to say, if it's bullish, we'll be in there. If it's going down, there's no sense in losing money. And we could take it off the table and be more conservative and come back, because it's always going to bounce back at some time. So it might not be the answer you want to hear, but that's how we're going to go ahead and manage it. Okay. So any other questions in chat or anything?
Since I'm retired and don't withdraw any money right now, should I adjust to just keep my money safe?
It was a person that was just retiring, approaching retirement, about keeping his money safe. Well, that's more of a personal question, and I don't mind if you want to talk to me, set up a time to talk about that later. I talked to one of our subscribers. In fact, just yesterday, I had a good conversation with him, who's also in the same boat. But it all gets into, you know how much you're currently making, you know how much you're going to make in retirement, projected. And if you have, let's say, $2 million, or I'm going to say $1 million, I'll just make it easy. If you have $1 million and you're getting 4%, which is what you would get if it was all in the G fund, 4% of $1 million is $40,000 a year. And then maybe you're getting your regular TSP annuity, and then maybe some Social Security. If your living expenses are $60,000 and 40,000 of that is coming from the G fund, and you only have to get another 20K from Social Security and your years of service, then you're probably doing good. But again, it's hard to do that without having all the facts. So I would, if you do have that, you have to be careful on your situation. It's all personal, and it's all driven by the amount of risk that you want. I've seen also happen going back in 2008, where somebody say, okay, I want to go ahead and I want to retire, but now all of a sudden the market took a 45-50% hit, and they weren't in the G fund, they were in the C fund, let's say, and then they had to postpone their retirement. So again, it requires a little bit more detail than just a real quick answer to that. But if you have enough money in a G fund and you want to retire, the G fund, consider using the annuities that the TSP has available as you near your retirement age. But please give me a call or text me or email me, and we can sit down for an hour and go over your personal situation. I could try to help you out. Anybody else?
Okay. All right. Due to TSP tips, been investing as you advised. Should I start investing 25% in the mutual fund window?
If you're young, it was I don't know if everyone could heard the question, but I'm new to the TSP. It's in the chat. It's in the chat. Should I invest the 25%? If I was younger, and I had time, yes, I would do it. If I would first go make sure that you go into the aggressive fund and see how you like, or aggressive model, excuse me, and see how you like that. And the difference between the aggressive, moderate, and conservative is basically the aggressive, we utilize one fund, and it's allocated 60% to the C fund. In the moderate, it's the C and the S fund, and the conservative is all three, the C, S, and I funds. So yes, I would consider it.
Like
You can go ahead.
it's like the
I actually had scotch.
Yeah.
She was like,
You can go ahead and put in whether 25%. Remember the criteria. It says you have to, if you're new, very new, it says you can know, you'll have to put at least 25% in
so I
is
was
the
like,
maximum.
so I,
It needs a minimum of $10,000. So your TSP balance has to be around $40,000, but it's something to consider.
Okay, I am retired and missed the emails, and I'm still 51C and 49S. How do I get back on track?
it's this call.
Well, somebody was asking, they missed
For
something
savings
else, and 51C and what,
49S.
40S?
How do they get back on track?
How do you get back on track?
Did she?
I would, if you get off track, take a look at it and see where our current allocation is, which is, I'm going to say 50% C. Okay.
Next week.
I would actually go ahead and
Lately.
take a look at that and consider getting back on track by selling your S fund and keeping 50% in the C fund in order to try to get back on track. Okay. And
this guy is not good
so
speaking.
Anybody else have any chat?
Okay,
And somebody has a hot mic.
all right, so. Do you foresee small mid-cap S fund to have the most opportunity for growth compared to the C fund as the year goes forward?
Actually, I'll let the numbers count and you can see what the S fund has done. Everybody's been talking about the S fund and how the market needs to broaden out and get away from the Mag 7, but everybody talks about it, but it's never happened yet. It hasn't happened in the last year. Maybe it will, but if you look at the S fund, it goes through some spikes. It's volatile. And if based upon the performance ranking, we might take a portion of it in there. But at times it feels like when you get into the S fund, it has very quick acceleration and then it will fall off too. So
You give her food.
any other questions in chat?
I don't think so. I put your phone number and email in there as well.
Okay, so I'll open the mic up again to anybody that's out there. If you don't have a question and we don't have any more in chat, anybody else want to go ahead and chime in with one last chance for a Q&A? Okay, so we'll send out the presentation to all those people that were invited, that took up our invite today. Send it out to you, and then we'll be sending out an update this next week, and we'll see what happens with the markets there. Okay, and thank you very much for showing up, and I really appreciate it. If you have any further questions or need any advice, individualized type of advice, feel free to either call me or text us at the TSP contacts at TSP, and Justin will go ahead and forward the email to me, and we can set up a time for an individual consult. Okay, well, thank you very much for showing on up tonight, and have a good 2025. Hope it's a bullish one. Thank you.